Since the outbreak of the latest Middle East war, the global economy has entered a period of heightened volatility, shaped primarily by energy disruption, geopolitical uncertainty, and uneven regional resilience. Major international institutions note that the conflict has already slowed global momentum and increased downside risks to growth. At the center of the economic shock is oil. The Middle East remains the world's most critical energy exporting region, and fears of prolonged instability, especially around key chokepoints like the Strait of Hormuz, have driven sharp fluctuations in crude prices. Even when actual supply isn't fully cut, the risk premium alone has pushed prices upward, keeping energy costs elevated worldwide. Financial markets have reacted in waves. Initially, equities fell as investors fled to safer assets like gold and U.S. Treasury bonds. Over time, markets have shown some resilience, with energy and defense sectors outperforming. Still, volatility remains high, and investor confidence is fragile, with markets reacting quickly to any escalation or signs of de-escalation. Trade flows have also been disrupted. Shipping routes in and around the Gulf have become more expensive and risky, increasing insurance costs and delaying deliveries. This has compounded existing global supply chain weaknesses left over from the pandemic, creating broader ripple effects across industries and regions. One of the most significant impacts has been on emerging markets. Countries heavily dependent on energy imports, such as India, are facing mounting fiscal pressure as governments attempt to subsidize fuel and protect consumers. This has led to widening budget deficits, currency strain, and rising debt risks. Inflation has proven stubborn globally. Central banks, including the U.S. Federal Reserve and the European Central Bank, have been forced to keep interest rates higher for longer. While this helps control inflation, it also slows economic growth and raises borrowing costs for businesses and households. Geopolitically, the war has accelerated economic fragmentation. Countries are increasingly prioritizing energy security and strategic independence over efficiency, leading to a shift away from globalization toward regionalization, with supply chains and alliances being reshaped along political lines. In summary, the global economy since the start of the war has been defined by energy-driven inflation, fragile market stability, disrupted trade, and growing divergence between energy exporters and importers. While a global recession has so far been avoided, growth is weaker, risks are elevated, and the outlook remains highly uncertain.